so people should be trickling in. I'm going to be kind of letting people in as they join. But I want to just start by thanking you guys all for being here. This is going to be a very, very informative, very powerful event. I'm very excited to be hosting this with everybody. I met Stefan just kind of by chance recently, mutual Facebook friends, I think. And, I looked on his page. I saw some of his videos about trust and what they could do. And, being previously in real estate, I'd heard of trust. I know a lot of people know a little bit about trust, but I didn't realize how powerful they are. So I watched some of his videos. I was very impressed, sent him a message. We ended up meeting together, and man, I was blown away with the information I learned in just a very short amount of time, and I barely scratched the surface. So I just want to kind of, as we let people in here, give that introduction. This is going to be some great information for you guys. We will do a question and answer at the end. So make sure to stick around if you guys have any questions. We love to have interaction on these Zooms. So if you can, we'd love to have the cameras on. It always makes these Zooms a lot more fun when we can see people's faces. We can see the disbelief, when he tells me some of these things that I've learned from Stefan in the short time I've known him. I've been honestly just blown away with some of the stuff I've heard. So we love the cameras on. We love the interaction. He's going to ask you to put some 1s in the chat, some 5 in the chat, that sort of thing. And I want to also encourage you to take notes. This will be recorded. We'll send you guys all the links afterwards. And at the end, like I said, we're going to do a question and answer. So if you have questions, we want to try to keep this thing moving along, but also, if there's like a burning question, you got to ask it, feel free to jump off mute. But with that said, we're going to cover a few things here. We're going to talk about asset protection, using trust for real estate. And then the big one that a lot of people are interested in is tax minimization as well as just like general trust knowledge. Like I said, I had known about trust a little bit, but not nearly to the extent that I should. And after my brief interactions with Stefan, I was absolutely blown away with the amount of knowledge he has on these things. So with that being said, I'm going to pass it over. We're going to start this thing up. We're all adults here. We get to our events on time. So I appreciate you guys all being here. And Stefan, why don't you take it away?
Awesome. Thanks for the intro, Christian. And we'll definitely get right into it. I'm a big fan of, like you said, if you have questions, I'm the type of person, if I don't get it off my mind right away, I will forget. I'm 39 years young and getting older, and it just happens. So if that's the case, just, unmute, raise your hand, whatever, and kind of get it out. But we're, slated for about an hour. It could run a little over. If you have a hard stop at 1 o'clock, that's fine. I understand it, but I want to make sure that everyone gets their questions answered and understands everything, and can kind of take it from there. And I want to kind of go through a lot of the slides as quickly as I can, because I really want to go and spend a lot of time around whiteboard discussions and drawing things out, because I'm a very visual person, and most people are when it comes to information. Is one thing to hear a talking head like me, or see some slides. It's another thing to kind of see it drawn out. The old saying, a picture says 1,000 words. So that's really what I'm excited to get to, and then obviously the Q&A. So that being said, grab your drink or water. This is water, even though it's a Dixie cup. I'm going to take stops and drink water, and we'll take it from there. So let me just get my screen set up, and we'll get into this. All right. Can everyone see my screen? Thumbs up. You can see it, everyone? Okay, good. All right. All right, so this is all about benefiting from trust while you're alive. We're going to talk about benefiting from trust while you're dead, but most of you guys here are alive on the call, so why not talk about benefiting from trust while you're alive? So that's what this is going to be all about. Now, this presentation, I am not your CPA, your attorney. This presentation is not legal, financial, or tax advice. Now, we do give legal, financial, and tax advice if you hire us, but as for the confines of this presentation, this is just for informational and educational purposes only. I'm going to go over a case study as well. So, everyone's situation is different. Don't really assume that anything here is going to apply to your particular situation. And last but not least, don't take my word for it. It's 2024, right? We have Chat GPT, Perplexity, Copilot, Google this stuff, take your notes, Google this stuff, research it, and see for yourself, what some of these things are and what the possibilities are. Now, as Christian said, this is interactive. We want your questions. We want your contributions. If any of you guys, I see Jerry, he's been on a few of my calls before. I got some people on live stream. I like to pick on people. So I might pick on you just to kind of get your input, questions, things like that, input, and we'll take it from there. All right. Now, one of the things is if you decide to work with us, we'll go in a little bit about, our practice, proven wealth strategies, what we do, that sort of thing. But we're not here to take away any, trusted advisors that you have. If you have a CPA, financial advisor, attorney, you can keep those relationships. We're not trying to disrupt those things. We're just trying to enhance and, really put you in a much better position from a tax standpoint, make you more efficient. We're really going to talk about the difference between expensing and taking taxable distributions. Because most of you guys, if you have your own business, you do investments, you work, you earn money, you do your investments, you take your distributions, you pay taxes, and then you pay for your expenses. So we're going to show you how to do things efficiently using a trust. And if you are what we call a strategic partner, you're a financial advisor, money manager, CPA, whatever, we're going to really, if you want to, partner with us, we love entertaining those relationships because we help your clients. If you're a money manager, we can, help your clients keep more money because they're repaying less taxes and all that good stuff. So first thing I want to explain is that how your estate is set up, is managed, is put together, is structured. That means everything. Now, at the end of the day, some of you may have trust. Raise your hand here if you have a trust, or drop something in the chat box if you have a trust already. If okay. So I see some people have trust. Awesome. But how your trust is set up and managed means everything. And a lot of people, they spend a lot of money on trust, and it may not be what they actually want or what they think it does. And so we're going to uncover a lot of those things. But proper trust structure, and you'll hear me allude to that, really means everything. There's a lot of noise out there. Oh, this is the Rockefeller trust. This is the purist trust, all these different things out there. But they might not be doing things the right way, and you may not be getting what you actually want. So quick background on me. Again, my name is Stephan Bellholm. I'm a tax strategist, tax planner, certified tax strategist, and estate and trust specialist. So I've gone through the training and education and all that stuff to kind of understand this stuff. My dad's an accountant. I grew up in the tax world. I think taxes are very boring from what most CPAs and accountants do. It's very, adding ones and twos, putting, checking boxes and that sort of thing, which is important. You need that stuff, but it really doesn't help you at the end of the day. And so what we do is we work with a lot of CPAs, we work with a lot of tax firms around the country to help their clients, mitigate taxes. I'm not an attorney, so I'm going to be going over a lot of legal things. Thank goodness. Are any attorneys here? I don't mean to mess with you, but it's a little joke I have. But I'm not an attorney. Don't get bogged down into a lot of the work that attorneys do. But we do have a team of tax attorneys, forensic CPAs, bookkeepers, specialists, that this is all they do every single day, day in and day out. They set up these tax structures for business owners and investors all over the country, okay, and even internationally, because some of these tax structures you can use with in other countries. So if you have property in a country like Canada or Mexico or in Europe, you can use some of these tax structures for that. And so when we talk about estate and tax structures, anything from private foundations, special purpose vehicles, charitable strategies, charitable exchanges, risk management companies, trust, that's what we're going to be focusing on today. These are the type of structures that we work with and what we do. So the agenda is we're going to go over some basic trust and estate planning concepts. We'll talk about how most people use trust to pass on wealth, which is obviously very important. But then we're going to really deal and drill into how to benefit from trust while you're alive. And that's really boiling down to, protecting your assets and reducing taxes on your business, real estate, and investment income. And like I said, I want to try to get through as quick as possible to the whiteboard session and Q&A so I can field any questions and really give you a visual understanding of how this stuff works. So we're going to talk about death and taxes. It's a certainty in life. A lot of people don't like to talk about either of these subjects, but it's just something that everybody is going to have to deal with, right? And we'll start with the taxes part first, because obviously most of you guys are, either entrepreneurs, you're business owners, investors, and you deal with taxes. That's a very integral part of what you do, and really a lot of how you make your business decisions, right? Am I going to do this investment or that investment or whatever? And it's a lot more than just, capital gains and federal income taxes, right? You have your net investment tax or Obamacare tax, depreciation recapture for all those people that are in real estate, state taxes if you live in a state like California, up to 13.3%. I'm in North Carolina, Pinehurst. I'm not sure if anyone here is a golfer. Anyone here is into golf or plays golf or into golf? Okay, Jay. Okay, Frank. Awesome. Well, we just had the U.S. Open here. That was okay. You too. Awesome. We just had the U.S. Open here, and it was really exciting. We got the chance to rent our house out to a pro golfer, which was really exciting. And the best part was that because this is my primary residence I'm in right now, if you couldn't tell, I have a small office down the road. We meet with clients and stuff like that. But this house was rented out to the golfer, and we didn't pay any tax on that. So that was great. And so I'm sure some of you, if you're into tax, you've probably heard of the Augusta rule. I'm going to be showing you the British Open rule, which is much better. Okay. But yeah, state taxes, mortgage over debt or debt over basis taxes that a lot of people don't talk about in real estate. But if you have a property, and let's say that property is, $1 million, right? It's worth $1 million. Let's say, I'm sorry, the base is $1 million, but you have debt of $2 million. Well, the government can tax you up to 39.6% on that difference. A lot of people aren't aware of that. Even 1031 exchanges, most people don't realize that in certain states, 1031 exchanges can get taxed. A lot of people are blown away, and North Carolina is one of them, when they kind of understand that. But there's a lot of taxes that you have to deal with. On top of that, right, our government is always thinking of new creative ways to tax us more. And these are the current tax proposals. Who knows if they're going to pass or not, but the government's mulling over, increasing capital gains rates to, double what they are right now, increasing the Obamacare tax. They want to tax unrealized gains. They want to get rid of, step up in basis, limit 1031 exchanges. And I tell people very upfront, I'm not a political guy when it comes to taxes. I'm not a red guy. I'm not a blue guy. I'm a green guy. And the reality is, no matter what side of the aisle that you're on, the government is going to figure out a way to increase tax revenue, because that's how they stay in business. That's just how it works. So the question is, do you want to find out what the government is or isn't going to do? And the wealthiest people in this country, they don't want to find out, and they put themselves in a position to be immune from that. And that's because they understand how to use a tax code to their advantage. So this is all about using the tax code to your advantage. It's not about lying, cheating, stealing. This is about doing things a legal way, but using the tax code to your advantage. And one of the best quotes, I'm not sure if you've heard of this guy, Louis Brandeis. He was a U.S. Supreme Court justice, one of the first Jewish U.S. Supreme Court justice. And as a Jew myself, I think that's very, very important. But I think when it comes to tax avoidance, this is probably the best quote, and you can Google this. He's got a lot of different things that he said about the tax code. But this quote, he says, "I live in Alexandria, Virginia, near the Supreme Court chambers. It's a toll bridge across the Potomac, or Potomac, however you want to say it. And when in a rush, I pay the dollar toll and get home early. However, I usually drive outside the downtown section of the city and cross the Potomac on a free bridge. This bridge was placed outside the downtown Washington, D.C. area to serve as a useful social service, getting drivers to drive the extra mile and alleviate congestion during the rush hour. Now, if I went over the toll bridge and through the barrier without paying the toll, I would be committing tax evasion. If, however, I drive the extra mile and drive outside the city of Washington to the bridge, I'm using a legitimate, local, and suitable method of tax avoidance, and am performing a useful social service in doing so. So for my tax evasion, I should be punished. For my tax avoidance, I should be commended. And the key here with this whole thing is the tragedy of life today is that so few people know that the free bridge even exists. That's really all this is. Most people don't know that the free bridge exists. And that's what I'm going to be talking today about, is the free bridge. And a lot of people ask me, okay, why don't more people know this? They don't know that the free bridge exists. So you guys are going to learn about the free bridge. Now, again, big difference between tax avoidance and tax evasion, right? If you're doing something illegal, and I know being in business for as long as I have, there's then the whole, hey, I went to Subway, I got a sandwich, I'm going to write this off as a business expense. That's not a business expense, right? When you're doing things like that, you're not reporting income, false deductions, things like that. That's illegal. Okay, that's tax evasion. We don't participate in that. And again, I encourage you guys to do your homework, but the IRS puts out a document, a publication, and I think they update it every year, but it's called Recognizing Illegal Tax Avoidance Schemes. And one of the things you can see right here, it says, use a charitable trust to eliminate income. Do not pay taxes on capital gains. Guys, if anyone's telling you that is complete tax evasion, okay? That's illegal, and we don't participate in that, okay? But that type of stuff exists. Go on YouTube, Facebook, Instagram. You have all these tax bloggers talking about writing off your pool and all that garbage nonsense. There's right ways to do it. And so tax avoidance is legal, okay? And this right here is the IRS special book for special handbook for agents. So when the Biden administration hired all those IRS agents a few years ago, this is the book that they give them to train them on what to do. And in it, it specifically says that tax avoidance is not a criminal offense. Any attempt to reduce, avoid, or minimize or alleviate taxes, keyword here is legitimate. By legitimately means is permissible. So everything that we're going to be talking about today is about tax avoidance and not tax evasion. You hear it all the time. All the big companies, Amazon doesn't pay taxes. Walmart doesn't pay taxes. GE pays no taxes. That's because they understand the free bridge, right? And they understand that this is another guy, Billings Learned Hand. Has anyone ever heard of him? Billings Learned Hand? Well, okay, Christian, great. Well, if you haven't, Google him. He's got a lot of cool things that he said about the tax code as well. And both him and Louis Brandeis, you have to understand, these guys work for the federal government. They work for the government, right? As we say in the South, the government, right? So, if they're talking about this, then, what does it mean for the rest of us? But he said, in America, there are two tax systems, right? One for the informed and one for the uninformed, and both are legal. So the reality is it's completely legal for the government to make you pay more taxes than you need to if you're not informed, right? So this is all about making sure that you guys are informed. And most people are not informed about the benefits of a properly structured trust. Okay. So let's talk about death, because when we talk about trust, for the most part, we're talking about death. And the reality is that everybody's going to die, right? We don't like to think about it all the time, but it happens. I just had a really high school teacher of mine. His son just passed away in an accident last week. Very unfortunate. I don't think any parent should have to, live through their child passing away, but it happens. And in 2019, it's the last statistics that I could find where we could match deaths and probates, but there was about 2.8 million deaths in the U.S. And about 2.1 million probate cases in the U.S. Now, does anyone not know what probate is? Does anyone know what probate is? Who knows? Just let's talk for a little bit, because I'm tired of talking. Does anyone know what probate is? Unmute yourself. Tell everyone here what probate is, if you've been through it before. Anybody? Don't be shy. It's your call.
Probate is basically when somebody leaves something behind. There's no will, or writing instructions on who the benefits or the sale of the property goes to.
Yes. Yep. It's and you've been through probate already, I'm assuming, right?
I have not done it yet, but as a real estate agent, I'm familiar with it.
Okay. So for those of you that aren't familiar with probate, as you said, yeah, it's basically the government getting in your business, as we say in the South. So probate is a government procedure where Uncle Sam decides who gets your assets. Okay. That's what probate is. And if you haven't gone through probate yet, fortunately, every one of us is going to go through it at some point in our lives, or our family's going to go through it. But it's hopefully you don't mind me getting spicy and cursing on here, but it's a bitch. Probate is a bitch. It's horrible. It's horrendous. It's very expensive. It's very time consuming, causes a lot of issues emotionally, um, on top of financial. But it's not something that anyone wants to go to. But the reality is that most people go through probate because they don't have an estate plan. They don't have anything set up in place. Even a will, we'll talk about a will and all that stuff. But probate is essentially the courts deciding who receives your assets. So we get all your assets, they put them on a line item, and the courts, the government, an executor has to get appointed. They figure out, who's going to who, or what's going to, I should say. So again, it's very expensive. You have attorney's fees. I mean, most probates could probably eat up anywhere from 5 to 10%. I'm actually dealing, unfortunately, with a client right now who their dad left. Well, I should say left. He had about $1.8 million. Since there wasn't anything set up in place, and they did have a will, by the way. I'll go into that next. The kids are probably going to get maybe $50,000. Maybe $50,000. Because what happens is when the probate comes in, everybody's alerted. It's not a private matter. It's all public record. So now you have all creditors and predators that come out of the woodworks. Hey, Bill owed me, $20,000, 50 years ago or whatever. All of that becomes part of it, and they can start attaching those things against your estate, all that money that you left behind. So, and on top of that, it can take a very, very, very long time. So you don't ever want to be caught up in probate, and a lot of people will get a will, okay? And, we'll sit down, we'll have conversations, Zoom sessions, whatever, and they'll say, okay, well, what if I get a will? And a will, something at the end of the day, some form of planning is better than nothing, right? And having a will, having a document, a piece of paper, a will saying, hey, this is what I want to go to Johnny or Susan or this or that. That's better than having nothing. But most people don't understand. And I've even talked to financial advisors, CFPs, people have a whole bunch of letters after their name, that don't understand that a will, I like to say a will send you to probate. Okay. So even if you have a will, you're setting yourself up for probate, because the courts have to decide, how that will was executed. Is it valid? Unfortunately, we have a lot of fraud in this day and age. So they have to go through all these different things to, document and make sure everything's okay before they dish out the money. And that's going through probate. So it's going to take a long time. It's all part of public record. Everybody can see it. They could just Google. I could go on the North Carolina, legal website right now and show you all the will cases and the probate cases. All your information is out in the open. So if you just have a will, and I'm not here to make anyone feel bad about any type of planning that they've already done, but I want to be honest with you, and I'd rather tell you things that you need to hear than things that you want to hear. And so if you just have a will, that's not foolproof. If you want to avoid probate. So having a trust obviously avoids probate. It's a private matter. All your dirty laundry or clean laundry isn't out in the open. It's a much quicker settlement process, because all they need really is just always someone calling me. Matter of fact, I'm going to mute my phone. Anyways. And all they need is the death certificate, and you can manage and have a lot more control with the trust after you die than with a will. With a will, you're going to have an executor, and that's pretty much it. And that's what leads to a lot of legal issues, honestly. So the question for everybody on the call really is, and I know we all have different family dynamics. I just finished staying with my in-laws in Florida for about a week while we were renting our house in the U.S. Open. But the reality is, do you love your family more than you love the government? Again, even on their worst days, I'm sure your family is what they are. But, if you don't take the proper measures and have the proper plans in place, the default plan for everybody, because everybody, I tell everyone, everyone has a estate plan. You either have your custom plan that you put together, your trust and everything, or you go to the government plan. So if you love your family more than the government, then you're going to want to set up a trust. Okay. And all a trust is it's a legal contract that separates, basically creates an entity, a separate entity outside of your personal estate to distribute your assets to your heirs. And it eliminates the whole need for probate court. So if we have a trust, you don't have to worry about going through probate. Now, let's talk about using trust a different way, because again, when I have these conversations, it's all about, okay, that's great, but what are some other things I can do? And most people don't understand that you don't have to die to benefit from a trust. The most people, again, the reason why they set up trust is to avoid probate. That's what I call the 99%. The average person, you go in a phone book, you call up an attorney and say, hey, I want a trust. They're going to set up a trust for you to help you avoid probate. And again, that's a very important thing. But wealthy people set up trust to not only avoid probate, but to avoid taxes, avoid liabilities, and avoid lawsuits. So if you guys are looking to do that, this is the right place to be in. And when you think about, all the different options and possibilities out there and what the wealthy do versus what the 99% do, the reason why they do it, it's all intentional. It's all for a purpose. So this, for example, AT&T, billion-dollar company, they had a $43 billion sale. And they use, as you can see right here, and again, Google all this stuff, they use something called a reverse Morris trust, and they paid no taxes on the gain from that deal. No taxes on the gain. So the average person, they got a real estate portfolio, right? They have some multifamily homes, single family homes, whatever. They've appreciated, they're going to sell them off. They got a, $1 million, $500,000 gain, they're going to pay capital gains tax. But the big companies pay no taxes on the gain. It's a completely different ballgame. Walmart. I'm a Walmart shopper. Okay, I have no shame in my game. I go to Walmart all the time. But the Waltons, if you know anything about Walmart, the Waltons have something called the Walton Family Holdings Trust, and they use this to have ownership and control of the Walmart company. Most people don't do that. The Kennedys. We've heard of the Kennedys. I actually went to college with the Kennedy family is very funny because it's a family that most people don't understand is just because their last name isn't Kennedy doesn't mean that they're part of the Kennedy clan, the Kennedy family. And so I know personally the Kennedy guy, really cool guy, drives like a Honda Accord. Not that there's anything wrong with a Honda Accord, but his family's filthy rich, but lives a very meager life. And the Kennedys, if you know anything, you do any research about Joe Kennedy. A lot of people talk about the Kennedy curse, but not a lot of people talk about the Kennedy purse. And the Kennedys to this day are very wealthy and they use trust, specifically Dynasty Trust, which is what we're going to be talking about. As you can see right here, it says handled correctly. If you look at the bottom, handled correctly, a Dynasty Trust could potentially maintain an untaxable fortune indefinitely. So we're talking about generational wealth that lasts decades. Okay, for a long time, but it's because they understand how to use the tax code. As you can see right here, it says how the 1 billion Kennedy family fortune defies death and taxes. I thought that's very funny title. But anyways, the main concept that I want everyone to understand before we kind of get into the meat and potatoes of this is that most people don't understand already that benefiting from a trust while you're alive is very common. We can talk about the Waltons and the Kennedys and the Rockefellers. We'll get into that. But a lot of people know about this stuff already. And I'll give you a big example. Has anyone heard of Social Security? Raise your hand if you heard of Social Security, if you know anyone that's on Social Security. All right. What is Social Security? Social Security is, who can give me the answer? $10 for the first person who can answer. $10.
It's a trust.
It's a trust. Social Security trust funds. Okay, just look it up. It's actually called the Old Age and Survivors Insurance. So it's actually insurance. That's a whole nother topic, which we won't get into. But it's managed through a trust. Pensions. Most people that have pensions, 401ks, retirement plans, those are managed through trust. Most people now, have, IRAs and stuff like that. But these old pensions and stuff like that and 401ks are managed through trust. They actually have trust documents as well. The golfers. Let's talk with the golfers. Who knows what this place is right here? Golfers, unmute yourself. What's this place over here? Come on now, you said you're golfers.
St. Andrews, Scotland.
St. Andrews, right? What's played there?
Oh.
I know
I'm gonna go out on a limb and say the Open.
Oh, the British Open, the Open
British
Championship.
Open, right? This is where golf really started. This is like the home of golf. They call it the home of golf. It's actually called, like Jay said, St. Andrews. It's called the St. Andrews Links Trust. Okay, so this has been managed by a trust and operated by a trust for decades. Not a lot of people know that. Hershey's, you like Hershey's chocolate? Hershey's Trust Company, set up by Milton Hershey over 100 years ago. So this stuff isn't like some foreign, outlandish, Illuminati, under the cave crap that no one, only 10 people know about. This stuff has been around. Trusts are actually one of the oldest ways to not only title property, but redirect income as well. What's this? Come on, guys, I want you to participate. Let's be quick. What's this? Anyone know what this is? Come on, $10.
That is what you fill out to tell the IRS that you're going to get income from someone, I believe.
Yeah. Yep, it's a W-9. So if you're in any type of sales or independent contractor, talk about contracts, independent contractor, you're going to fill out a W-9 form, right, to get paid, right? They're going to want your bank account, your routing account and account number, and then the W-9, okay? Now, can anyone tell me something with everything that I've just gone through before? What do you notice about this W-9 that you probably never really paid attention to before? Just take a quick look at it. See who gets it first. $10.
You got the trust and estate option in 3A.
Yep. Have you ever used that option? Did you know it exists? It exists. So, right, this is going back to the whole thing of what Louis Brandeis was talking about. This stuff exists. It's there. Most people don't use it. So yes, trust and estate, that is an option. So for a lot of you guys that are in real estate, you're in real estate sales, commissions, pharmaceutical sales, insurance sales, whatever. If you're filling out a W-9, you can use a trust. It's got a lot of good tax benefits. Most people don't understand S-Corps goes back to the late 50s. LLC, the first LLC, I think, was in Wyoming, 1977. Before all of that nonsense, and I'll go into why. And again, I'm not here to make anyone feel bad, but if you have an S-Corp or LLC, it's crap. And just so you know, I've had an LLC and S-Corp before. I actually still do have an LLC, but for other reasons. But anyways, prior to all of that stuff, LLCs, S-Corps, all businesses were run by either individuals, corporations, or trusts. If you know anything about antitrust law, we're going to get into Rockefeller, right? Antitrust. That's where it came from. They were breaking up his trusts, not his corporations, his trusts. LLCs. LLC stands for large lawsuit company. Hate to break it to you, not trying to make you feel bad, but if you have an LLC, most people get LLCs to protect their assets, protect their real estate, protect their income from whatever. But LLCs and S-Corps do not provide as much protection as you may think. It's called piercing the corporate veil. Has anyone heard of that term before? Piercing the corporate veil. Yeah. Happens all the time. And the reason, there's lots of reasons, but the biggest reason is that most LLCs, they fail to keep proper records and minutes and do everything that they're supposed to do. So if someone sues your LLC, they sue the members, they sue the directors, owners. There's different ways. People are smart nowadays, okay? And I don't care where you get your LLC set up, Wyoming, Nevada, Delaware, there's ways that people can pierce through these LLCs. And when they do, one of the biggest reasons that they're going to be able to pierce through it is due to alter ego. That's another term I want you to Google, alter ego. If you never heard of, anyone here heard of alter ego? Knows what alter ego is? What's alter ego? Jay, what's alter ego?
Alter ego is a veil. It's a veil identity. It means that if you're protected, alter ego means that your veil of protection is not there. It just means it's not there.
Yeah, it's you're operating. You think it's a corporation, but it's really your alter ego, right? You just set up a LLC. You got a plaque on the wall with the business name. It's not really a separate entity. So the government's going to say, or the court's rather going to say, that's not really a separate entity. That's you, and we're going to pierce through that. And on average, the states and federal courts pierce LLCs about 40% of the time. So if you have an LLC, just understand that it doesn't give you as much protection as possible. So, all right, so what is a trust? Trust, really, Black's Law Dictionary defines a trust as an equitable or beneficial right or title to land or other property held by one party for the benefit of another. Easiest way for me to explain that is trust is just a holding entity. It holds property, it holds assets for the benefit of another person who's going to be the beneficiary. I'll go into trust parties. But all the trust does is hold that property, and the trustees hold the legal and equitable title to the property for the benefit of the beneficiary. So a trust is a separate entity that basically holds those assets. So it's really no different, again, than an LLC or an S corp, but it gets tax benefits that a lot of those entities don't. So the parties of the trust, there's three parties. In a lot of cases, there'll be four parties. Is the settlor, who's the creator. It's basically who creates the trust. It's also known as the grantor or the trustor. And they basically create the trust and they fund the trust. Most people that have trust, and I'm not trying to pick on you, but if you have a trust, all right, for a trust to be valid, it has to be funded, meaning an asset has to be gifted into it or money has to be gifted into it. But if a trust is not funded, it's not a valid trust. And there are so many people out there, when I have conversations with them, we go through everything and realize their trust, they have a big, trust book or whatever, but it's just a very expensive paperweight. They pay $15,000, $20,000, whatever it is, $1,000, and it's not funded. It's not even set up right. So a trust needs to be created and needs to be funded. If it's not funded, it's not a valid trust. And the party that does that is the settlor or the grantor. We'll get into all that. The trustee is the person that manages the assets. They're the one that has the control, that can make changes, executive decisions, and all that stuff. A lot of times people will hire a bank, BB&T, branch banking and trust. There's lots of banks that do that are trustees for certain trusts. But we're going to talk about how we can make you guys a trustee. You don't want someone else, some Tom, Dick, and Harry holding, all your assets that you've worked so hard to put together. But the trustee is a person that has the most control, and that's a position that you want to be in. And then the beneficiaries are obviously the people that benefit from the trust estate. So when all is said and done, when you're no longer here on God's green earth, they're going to inherit the trust either by a distribution, or they can become the new trustees. And we'll talk about how that works. But the beneficiaries, while you're alive, don't have any they don't have any equitable title. They don't have any ownership in those assets that are in the trust. So mom and dad, and I talk to people a lot, they have, young kids, they just got out of college, or maybe they didn't go to college. They're pretty smart, but they're not really super, prudent with money. You can rest assured, okay? You can have your beneficiaries. They won't have access to anything in that trust, but they do have a beneficial interest. So just kind of understand that. And then the trust estate, that's basically where all the properties are, okay? So your trust estate is where all the assets, the property, and on all those things can become part of the trust corpus. You'll hear me refer to that. Corpus means body. It's Latin for body. That's where all the property, tangible, intangible assets, cash, all that stuff, that's what's going to be inside of the trust. So the proverbial, trinity or, triangle, you have the grantor, again, who creates the trustee right here at the top, and then the beneficiary benefits from the trust estate, and everything else is inside the trust corpus. Now, most people, I'm going to take a little break here, sip some water. So the people that have trusts, okay, this is just for the people that have trust. What kind of trust do you have? If you don't mind sharing.
I've got a living trust and have had a land trust created in the past.
Okay, awesome. Anyone else has a trust? Had a guy on the call. He's like, yeah, I have an irrevocable trust. I'm like, great. How much income do you take from it? It's like $50,000 a year. I'm like, not great. Anyone else had a trust? Nope. Once, twice? Okay. Well, most people that have trusts, they are set up as living trust, revocable trust, grantor trust. That's 99% of the time you call an attorney, go online, whatever, say, hey, I want to set up a trust. They're going to set up a living trust. And there's nothing wrong. Again, the trust is much better than the will. It's much better than having nothing. And it's going to make sure that your heirs, your beneficiaries avoid all the hassles and issues of probate. But a living trust is still part of your personal estate. Okay. Living trust, land trust, they're all part of you. These are called intravital trusts are still considered part of your personal estate until you die. When you die, then they become what are called irrevocable trust, AB trust, different variations, but they become basically a separate estate when you die. So it's kind of crazy, the term that we use with living trust, it really doesn't give any living benefits as far as asset protection and tax benefits, and that's because it's in your personal estate. The problem with these trusts, there's lots of different things we can go into, but just for argument's sake, is number one, these trusts use a simple tax code. And what that means is, like the guy I was talking to you before, he's got a whole bunch of money in an irrevocable trust, which is better than a revocable or a living trust, but he's still using the simple tax code. And the simple tax code, if you look at a 1041 tax return, we're not going to go into that'll put people to sleep, but it requires you to distribute the income and assets. So because this guy's required to take $50,000 every year, guess what? He's got to pay tax on that. So it subjects all of that income to capital gains, other taxes, and that sort of thing. The second thing is, because these things are set up as they're either living trust or living revocable trust, all that means is that you can take the assets back into your personal estate. So you can say, hey, one day I'm going to take this property, I'm going to put it in my trust. The next day you can wake up for whatever reason and say, you know what, I want to put it back in my personal estate. You can do it back and forth. And for that reason, from a legal and tax perspective, it's considered what's called single member. It's like an LLC, single member disregard. It's a disregarded entity, so it's still part of your personal estate. So it can be subject to lawsuits, liens, divorce, all types of legal issues. So there's two different estates that you have. The personal estate, that's where you own everything, right? It's in your name. It's titled into your personal name. On your trust estate, where you don't own it, right? It's part of a separate estate. Living trusts, again, are part of your personal estate until you die. When you die, then they become part of a trust estate. So if you want to have benefits while you're alive, and when I talk to people, it boils down to ABC, right? If you want, benefits while you want access, benefits, and control, right? You want to be able to have liquidity and use of your money and your assets, right? To do whatever you want, invest in whoever you want. You want benefits, meaning you want way to mitigate taxes and protect your assets and have privacy, not deal with all the BS that you have to deal with probate. And then obviously you want control. You want the control to be able to do whatever you want with your money. You don't want to have to ask somebody to do something, right? And so the way to do that is you have to operate out of your trust estate where you don't own anything to your personal versus your personal estate where you own everything. Because again, trust estate, access, benefits, and control. Personal estate, taxes, liabilities, and lawsuits. And I'm sure most of you guys, if you've been in business for a while, you've had to deal with a number of those. So if you want to benefit from a trust while you're alive, it really boils down to ownership. You don't want to own anything. You've probably heard of the whole Rockefeller rule. Has anyone heard of this before? Own nothing, control everything. Anyone heard of that before? Right? This is the reason why this exists. And John Rockefeller has been a big proponent of that saying when most people think about it. But again, all wealthy people, the Kennedys, the Waltons, the Gettys. You want to do some research the Gettys. The Gettys are like the most gangsterous family ever, especially when it comes to trust. But they understood this concept that when we have things in our personal estate, it can be taken from you. You can be sued to death, right? You can have all these issues. And when we talk about Rockefeller in particular, the biggest reason, again, antitrust. You research antitrust law. You know anything about antitrust law? This is where it comes from, because Standard Oil and Trust, which John Rockefeller, even to this day, is probably one of the wealthiest guys in America. He was getting too big. He was getting too wealthy, right? So they had to break up his companies. He ended up setting up other trusts, but that's where all of this comes from. Okay, is understanding the key to creating wealth and growing wealth, being more efficient, tax-wise and legal-wise, is to not own it, right? And when I talk to people One of the biggest questions I get is, why isn't everyone doing this? Well, it's simple. It's pride of ownership. People like to have their name on things. Hey, I worked hard. I did this. I did that. I want to have my name on stuff. And that's fine. But you're giving up access, benefits, and control. So if you want access and benefits and control, proper trust structure is required. And I'll keep drilling into that proper trust structure because, again, you go online, you Google ChatGPT, you'll hear a lot of things about, oh, I have a common law trust, I have a purist trust, I have this trust or that trust. If it's not set up right, it really doesn't matter. And we'll go into some actual examples of that. So we're going to go into Dynasty Trust, and that's what these are. Now, I'm sure some of you guys have maybe heard of the deferred sales trust. Has anyone heard of a deferred sales trust or a charitable remainder trust? Has anyone heard of those things? Well, if you have, that's not what this is. Okay, this is a completely different thing. We're talking about Dynasty Trust. Again, these things can last generations. They're also sometimes referred to as complex trust, family trust, spendthrift trust, irrevocable trust. They all kind of mean the same thing. But these are what are called dynasty class of trust because they don't require distributions, and you can basically have the money inside the trust for generations, decades. Okay. Now, if you've heard of anyone that's a trust fund baby, and my friend, I'm not going to air his name out, that's what he is. He's a really cool guy, drives a Honda Accord. But if you heard of that term, trust fund baby, or someone has a trust fund, has anyone heard that term before or used that term or know someone that has a trust fund? Maybe there's some people that know people that have trust funds, see a few people. Yeah, this is the type of trust that they have. And I'll go into detail on why that is in a little bit. So that's a cute baby, by the way, right? It's a cute baby. Anyways, so there are a few different essential components to these trusts. I want to kind of break those down because when I break these down, it's really going to start to make more sense, especially for those of you that do have trust. But the provisions are, drink some water real quick. Non-statutory, non-self-settled, non-grantor, irrevocable, dual track, discretionary, and then spendthrift provisions. So I'll go through all those. Before I do, real quick, any questions, or I just want to take a break real quick, Christian, because I saw some stuff in the comments. Any questions that people have right now? You want to unmute on anything that I talked about before?
Yeah, guys, if you have any questions, feel free to come off mute or put them in the chat. I'm making notes of any questions. So, yeah.
Okay. No one wants to talk today. All right, great. All right, so first provision, non-statutory. Okay, non-statutory is very, very important because what this means is that it's based off of contract law. Okay, now in this country, in the United States, we have the private right to contract. Everything is a contract, right? We talked about the W-9 form, right? That's for what? Independent contractors, right? When you're contracting with a company. Your mortgage. Anyone here has a mortgage? I have a mortgage, right? If you have a mortgage, that's what? That's a contract, right? You have insurance. You have homeowners insurance. You have life insurance, health insurance. It's a contract. Employment, right? You have employees. There's an employment contract. If we didn't have contracts in this country, we wouldn't exist, okay? So contracts are the bedrock financially to how this country operates. And when it comes to trust, again, trust is a legal contract, but what type of contract do you have? So when we talk about these dynasty trusts, we're talking about trusts that are non-statutory. So they're not created by state, right? They're not like an LLC or corporation where you have different state rules and regulations. These are what we call federally chartered trusts. They're not a creature of state legislation. So they're above, hey, if Wyoming makes a decision or changes things on how their trusts operate, or California or Florida, whatever state you have set your trust up, these dynasty trusts aren't affected by that. And again, that's why the wealthy people do things like that. So again, not trying to make you feel bad, throw your trust under a bus, but if you do have a trust, most likely it's a statutory trust that does not have the same provisions and protections. And at the end of the day, it requires the use of this simple tax code. So again, the money has to be distributed to beneficiaries. So if you did fill out your W-9 and use your trust, if your trust even had an EIN number, guess what? You'd have to distribute that income every single year and it would go on your 1040. You're not saving any taxes. So non-statutory is the main provision that you want. But the other thing is non-self-settled. And self-settled, you can Google this term as well. Self-settled is, and not every state provides self-settled trust, but a self-settled trust means a trust that you remember the term for settlor, that's who creates the trust. You are the settlor or the grantor of the trust. So a non-self-settled trust is a trust that you are never the grantor, the settlor of the trust, or the beneficiary of the trust. Because when you have like a living trust or irrevocable trust or whatever, most of the time you are the trustee, the grantor, and the beneficiary. You're all three parties. So because of that reason, the government's going to treat it just like a single member LLC, single member disregarded. So these trusts are not self-settled. You're just appointed as the trustee. And these are also non-grantor, which means the grantor, whoever's setting up the trust for legal reasons, cannot be you. So way it works is a grantor that's setting up these trusts is a non-related party, meaning it's not related to you, not your brother, not your sister, not your mom, not your son, not related to you. That person sets up the trust, they fund it. Because again, if it's not funded, it's not a legal trust, not a valid trust. Then they resign from the trust after creating it. So they relinquish all rights and access to that trust. And this exempts the trust from that alter ego. Because again, alter ego, if you ever, if you Google the word alter ego, Jay brought that up, alter ego, self-dealing, that's another word. The IRS hates those things. And when they see that or they even sniff that, they're going to come down hard on you. So these trusts are set up specifically to avoid that alter ego status and gives you that asset protection because the settlor is separated from the corpus. Irrevocable. So we talked about the difference between a revocable, or I guess we didn't. Well, we talked about revocable, okay? Revocable means you can revoke the asset, meaning you can take the asset out of your personal name, put it back into your trust name, go back and forth. You can revoke it as much as you want. Irrevocable is the opposite. That means once you put in the trust, once you transfer that asset to the trust, you cannot revoke that back to your personal estate, okay? A lot of people get spooked about that because it's like, oh, it's gone forever. No, it's not if you understand how these things work. So the irrevocable provision of the trust, a component of the trust, provides that tax advantage because the government says, okay, if it's irrevocable, it means you can't put it back in your personal estate. We can kind of consider it a separate trust estate. So it gives you a little bit of tax benefit in that aspect, but it's really the liability aspect, the legal aspect of the irrevocable provision, because now it's irrevocable. Hey, I can't take it and put it back into my personal estate even if I wanted to. So if you sue me or try to come after me, there's nothing that's going to happen. But that's got some tax provisions built into it and some asset protections built into it as well.
Can I say something real quick on that, Stefan?
Yeah.
Guys, just this quick side note. If you are ever in a situation where someone's looking to sue you, the very first thing the attorneys do is they look and see what can we get out of this. If they look at you and they do not see that they can make a buck off of you, you ain't gonna get sued, right? So that's a very important thing to understand about this. Is like back to the own nothing, control everything. Is like if you don't own anything, they're not gonna even go after you. Right. And even if they do, if stuff is in an LLC or whatever, and they're not legally entitled to it, you still might have court fees, lawyer fees, all of that. But if you don't own anything, they're not even going to go after you in the first place. So,
no. And I tell people all the time, lawyers aren't stupid. They went to college for that amount of years for a reason, and they only sue people for insurance, income, or assets. Insurance, income, and assets, right? If you don't have any of those things, they're not going to touch you because it's a waste of their time. But no, that's 100% correct. Dual track. So we talked about, and I want to get too in detail into this part, but there's two different provisions when it comes to trust, either the complex or the simple. I think it's a funny word because the tax code itself is complex, but the simple provision, this is what most people have when they have living trust, or even if they have irrevocable trust, is they use the simple provision, which requires, again, for them to distribute. But when you have a complex code, when you have a complex trust, when you're able to use the complex provisions based off of your trust setup, then you can accumulate that income. You don't have to distribute that income. So we can just keep that money growing and growing and growing and growing from your real estate, from your business, your rental properties, whatever you're doing. And you don't have to worry about the tax man coming to take their share because you're not making a distribution. If you have a simple trust, then you are required, you must distribute any earnings or income to beneficiaries. with the trust. So with these trusts, it's got a dual track, and I'll kind of explain. But we were set up on the complex, but we have the right, if we want to use the simple. And there's some reasons where when you may want to do that. We'll go into that later. And then the spendthrift provision. Has anyone heard of the word spendthrift, or heard of spendthrift provision or spendthrift trust? Has anyone heard of that before? Raise your hand. No? Nobody? Okay. Well, most of the time, if people have heard of that word, it's usually okay. Little Johnny, he's got a bad habit with drugs and prostitutes or whatever. If we leave him some money, we want to make sure that he doesn't take that money and do some bad stuff with it or whatever. He's irresponsible or whatever. So that's a lot of times when people have heard of that word, they use it, and there are some contexts and there's provisions within these trusts that do provide for that. But the real meat and potatoes of the spendthrift provision is the asset protection, because what the spendthrift provision does is it allows the trust corpus. Remember, the trust estate, that corpus, that's where all the money and the assets are. It allows that trust to be impenetrable from any turnover orders or liens or judgments, because what the spendthrift provision does is it separates the assets, the title of the asset, from the owner of the asset. So it essentially makes the trust the owner. But again, what I like to tell people, even though we say own nothing, control everything, even the trust doesn't own it. Okay, the trust is just holding that. It's holding the asset for the beneficiary. But if we're not required to distribute, we can keep that growing and growing every single year for generations and generations. And this actually is probably the most powerful provision of all when it comes to the asset protection. So just to kind of understand how the trust works, again, it's a separate entity. When you set up these trusts, you're going to get an actual EIN. Again, it's a federally chartered EIN. Federally chartered trust. You're going to get an EIN. You're going to have to do a tax return every year on what's called the 1041. So as an individual, you probably are familiar with the 1040. That's for individuals. The 1041 is for trusts and estates. So you're going to have to file a tax return every year for the trust. Even though you're not taking distributions and you're not paying tax on that income, you're still going to have to file a tax return. Okay. There's a bank account. There's bookkeeping that's involved, P&L, balance sheet. The trust itself actually does, because it has an EIN, it does, build its own credit score and profile. So this is really no different than an LLC, but the difference is all that income is tax deferred indefinitely. So we're not talking about evading taxes. We're deferring taxes no differently than you would in your 401k or the 1031 exchange, and we'll get into that with real estate. But that's how the trust is set up. So from an income standpoint, there's two different types of income. There's passive income and active income, right? If you have an active business, you're, an LLC, or you're independent contractor, you have a business, those types of income cannot go directly into the trust. There are different creative ways that we can get it into the trust, and I'll explain how that works, but that's active income. Passive income, so rental income, you have a whole bunch of rental properties, you invest in crypto, stocks. We have a lot of people that do, oil and gas royalties, Texas, Virginia, West Virginia, Pennsylvania. All of those passive assets that you purchase, you can put those inside the trust and avoid taxes indefinitely. And I'll explain how that works. So the 6 types of passive income that are not considered taxable, it's actually not even considered income, okay? Not considered income, and I'll explain how that works in detail per the IRS, are capital gain income. So if you have real estate, you have, single family homes, you're flipping properties left and right, multi-member, doesn't matter, multifamily homes. If you're selling property for a gain, that type of income, dividend income, so, stocks, that sort of thing, rental properties, interest. We have a lot of people that do private notes, structured notes, different things like that, royalties, and then passive K1s. We have a lot of people that are into equity funds or REITs and things like that. Any type of passive income, those are the types of income that we can stick into the trust and avoid taxes on. The reason why, I'll go into that in a bit, is because of what the tax code actually says with these trusts. Now, there's lots of different tax codes. I don't want to get into detail, 665, 662. We're really going to focus the bedrock of kind of how this functions is 643. And we have a private letter ruling. So if you have a CPA or tax attorney or an accountant, and you bring up a new strategy or an idea or whatever, they're going to want to see a private letter ruling, right? They're going to want to see, audits and stuff. We have all that stuff. We can go over that later. But this comes directly from the private letter ruling, which is from the IRS. And I want to read this out to you, and I want to explain this out to you. And again, we'll get into some whiteboards in a little bit and Q&A, because this is really going to make a lot more sense. But right here in the bold, it says items of gross income. So gross income is obviously the income that you generate from your rental properties or capital gains, whatever, constituting extraordinary dividend. And for those of you who don't know what a dividend, all a dividend is a return on capital. So capital gains is considered a dividend. Most people don't know that. Interest income is considered a dividend. So items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary is who? The trustee, okay? Acting in good faith, meaning they're following the letter of the law, determines to be allocable to corpus. So again, at the end of the day, when you're using this, everything has to be allocated to corpus. If we allocate it to your personal estate, guess what? You're paying taxes, right? So everything has to be allocated to the corpus, to the trust itself, which is, again, separate entity, okay? Under the terms of the governing instrument. You'll hear that word governing instrument sprinkled all throughout the tax code, but governing instrument is your trust document, right? If you have a 401k, anyone have a 401k?
No.
Some people have 401ks. Okay, guess what? Your 401k has a document. That's a governing instrument of your 401k. Okay. Some 401ks, and I talk to people all the time, don't realize some 401ks, we'll get into insurance. A lot of people like insurance. They like life insurance, infinite banking, bank on yourself, whatever. Some 401ks allow you to buy insurance within your 401k, but some 401ks don't. What determines that? The governing instrument, the documents within your 401k. So governing instrument and applicable local law. Again, here's the catcher right here. Shall not be considered income. Shall not be considered income. So if it's not considered income, what does that mean? Let's see who can answer this. $10.
No tax.
It's not tax. Not tax for that year. Okay. For that tax year. It can be considered income down the future, right? But we can defer that income for decades, generations. Again, Dynasty Trust, that's the whole concept. So again, if you're familiar with how 401ks, 1031 exchange, how tax deferral works, this is tax deferral but on steroids, okay? So all that passive income goes into the trust estate corpus, and then it gets filed on your 1041, okay? That's the simplest, easiest way to understand it. So these trusts from a legal standpoint are written to comply with 8 different trust law categories. Now, a lot of times people talk about common law, okay, or contract law. And that goes back, over 500 years back to Europe with the chancery courts and all that stuff, which I won't get into. But most of common law or contract law was abolished in the 50s when the Uniform Commercial Code came out. So if you're talking to someone that says, oh, I have a pure trust or I have a common law or a contract trust, it needs to be a lot more than that. It needs to have a lot more built into that. So these trusts that are put together legally are written to comply with all the different codes out there, the U.S. Constitution, U.S. Supreme Court, and other court decisions. We can go over that another time. And any contract, trust, and tax laws within all 50 states. So it doesn't matter where you live. I'm in North Carolina. I have clients in Texas, California, Florida, all over the country, and that have properties in different states. So it doesn't matter what property. Again, these are non-statutory. So you could live in California, and I have a lot of people that are moving to California because of the taxes. But hey, you can stay in California, operate your rental or whatever business that you're doing, stay in California and not get killed with state taxes. So the trust law categories, Uniform Commercial Code, Scott on Trust Law. Has anyone heard of Scott on Trust Law? Anyone here ever heard on Scott on Trust Law? Well, if you have an attorney, I would talk to them about Scott on trust law, because if they don't know about Scott on trust law, especially if they're a trust attorney, they probably don't know a whole lot about how these trusts operate. Sorry, I'm going ahead a few slides, but that's a big one. Most law schools now, to even begin to learn about trust, you have to learn Scott on trust law. And it's a whole other thing we'll go into another time. Uniform trust code, all these different things. So let's talk about trust in real estate. I know a lot of you guys probably have real estate. And a big one for people that have real estate holdings is the 1031 exchange. Has anyone here ever done a 1031 exchange? Raise your hand, comment if you've done a 1031 exchange. See, Raphael, this guy online from stream Facebook. I don't think the Facebook people can comment, the live stream people. Anyone here? No? Okay. Well, 1031 exchanges, that's a good strategy if you're trying to avoid capital gains, but there are some stressors. There's a lot of intricacies. You have to find a property within 45 days, close within 180 days. There's a lot of deadlines and stressors with the 1031 exchange if you're selling real estate and you're trying to avoid capital gain. With the trust, you don't have any deadlines. You can sell your property right now, and you don't have to worry about, hey, I need to find another exchange within a certain amount of time. 1031 exchanges also only work with investment real estate. With the trust, you can buy any property, any asset, doesn't matter what it is. You want to sell your multifamily building and then go invest in crypto or stocks or oil and gas, whatever, you can do that. You can't do that with the 1031 exchange. It only works with investment property. So even if you wanted to stay in real estate, but you wanted to go from, selling this commercial property to doing, a primary residence, you couldn't do that. Trust, you can. Okay. It has to be of equal or greater value if you're doing a 1031. Trust, doesn't matter. I have a guy right now. He's sold a commercial property for about $10 million, and he's going to buy a whole bunch of tiny homes. He's going to buy like maybe 15 or 20 tiny homes. And he's going to do some other stuff with his money. And the biggest thing with 1031 exchanges, and again, I'm not trying to knock every strategy out there, but with 1031s, you're really forced to buy at the height of the market, right? And if you're in real estate, you know that what's the goal? You got to buy low and sell high, right? But if you're doing a 1031 exchange, you're automatically going to be buying at the height of the market, right? Because you're selling your property when it's worth a lot, and so is everyone else. So a trust allows you to sell your property and sit back and figure out when and what you want to buy. It gives you a lot of more options. So this is really buying from a position of power. Landlords, if you have properties, multifamily properties, single family properties, doesn't matter. You know the issue of tenants, right? Tenants, toilets, and trash, they call it. And so again, trust-owned properties provide much better protection than LLCs. I have a client who's in California during COVID. Obviously, there's a moratorium on rent collection. He got killed, and his tenants were all driving BMWs and Mercedes, and they had money, they just weren't paying rent. And one of them tried to sue him. Guess what? Couldn't get anything because he had a trust. Okay, and all that rental income is tax deferred into the trust. So if you're in real estate and you're constantly trying to figure out, oh, what do I do this year? Do I, renew my real estate license? Because a lot of people are trying to, being, real estate, the reps, being a registered real estate professional. You don't need to do all of that stuff when you have a trust. You can say, hey, I run a restaurant. That's my full-time gig, but I want to do real estate as well. You don't have to go and put the hours in to do that. You also don't need depreciation. And this is what kills people with real estate every single year, is that depreciation. Is, hey, I'm going to go do a cost segregation study or bonus depreciation to get my tax bill down. And that's fine. But when you sell, then you get raked through the coals because you're paying that capital gains, you're paying depreciation recapture, you're paying state taxes and all that stuff. So when you have the trust, you don't have to worry about, paying those recapture taxes when you eventually decide to sell that property. So a lot of people will say, okay, great. The trust, I have a trust. I have all this money. I saved a whole bunch of money in taxes, but all the money's in the trust, right? It's owned by the trust. It's held by the trust. What can I do with it? How do I take money out of the trust? How do I get money out of the trust? That's like the number one question I get. And again, everybody learns at different levels and understands things differently. But I'm like, Do you just hear what I just said? You don't want to own anything. You don't want to take money out of your trust, right? So you can have taxes, liabilities, and lawsuits. That makes no sense. So you want to do things as much as you can in the trust. That's what trust fund babies are. That's what people that have trust funds actually do. So the trust can purchase any investment, any real property, or any asset that you could purchase. It's just going to be owned by the trust. So if you want real estate, guess what? You can have the trust own the real estate. Okay. Your primary residence, this house that I'm in right now, it's owned by the trust. Okay. So vehicles, you have a car, have your car owned by the trust. Get that asset protection. Okay. And we can go into the legalities of why you'd want to do that. All you got to do is turn on the TV and you see 1-800-CALL Larry. Larry got me $8 million. You know, I got tapped in the back or semi hit you. When people get sued when they have their assets in either an LLC or personally, or even if they have an umbrella policy, guess what? If you get sued and you're held liable, you're screwed. And when people sue you, they're suing for punitive damages. They're not going for policy limits. They're suing for a lot of money. So having your assets in a trust gives you a lot more asset protection. But anything you can think of, land, Forex, crypto, insurance, oil and gas, all the things that you could invest in yourself, you can do that within the trust. And the second part is this. And the reason why you want to do that is because if the trust owns it, then the trust pays the bill. If the trust owns it, the trust pays the bill, and it pays it with pre-tax dollars. I mean, think about it. Most people that are on this call, you have a house, right? Who has a mortgage? Anyone here have a mortgage? Raise your hand if you have a mortgage, right? Raise your hand if you like paying the bank. Anyone like paying? All right, no one's, all right, good, great. Now you can keep your hands down. But no one likes paying the bank. But we all have to if we're going to get a mortgage. But wouldn't you like to pay the bank with pre-tax dollars versus post-tax dollars, right? Versus working, earning money, paying taxes, and then paying the mortgage? You can do that with the trust. So your mortgage, your notes, if you have a car, your car note, that can be paid for by the trust if the trust owns your car. Your property taxes, insurance, utilities, gas, water, all of these different expenses that happen. This past year alone, my dishwasher broke, my fridge broke, I don't know if you can see it here. This is a wall AC unit. We had to put this in because right after the US Open, I made a whole bunch of money for my house. The upstairs unit decided to take a crap, right? So all these things, we have to deal with it. But most people, they're paying on an after-tax basis, which makes it a lot more expensive, right? This is paid for by the trust. I went to Lowe's, got this AC unit, $500 until they can come and fix the AC. That's paid for by the trust, okay? It's a trust expense. So this is the position that you want to be in. You don't want to have to take money out of your personal pocket to pay for these things. And then the other thing is your other, what we call trustee and beneficiary expenses. Because the reality is a lot of people, you may want to go on vacation, you may want to buy some Nikes or a Dior bag or whatever it is, but those aren't necessarily trust expenses. But there are certain trust expenses, like if you have kids. Anyone here have kids? What I call liabilities. Anyone have liabilities? Sweet little liability.
You got muted, Stefan.
I don't know why I did
Sweet
that.
little liabilities, the last things I heard.
Okay. So my little liabilities, which are my kids, sorry, I'm back. The trust pays for all of their medical, healthcare, and welfare expenses. So when it comes to, we need some money to go to camp or this or that, or their healthcare expenses, insurance, even educational expenses. You have kids that are paying for college right now. Guess what? That's a trust expense. Now I can pay for college on pre-tax money. Oh, and by the way, if I want to get financial aid, do you think the financial aid knows how much I have in my trust fund? I have clients that have $8-10 million in their trust, and they're getting full ride scholarships at Duke University, North Carolina. Legally, because they're using the tax code. They're doing things the right way. But most people, that school's like $90,000 a year. It's ridiculous. Now that's for beneficiaries. So anyone that's under the age of 21, the trust can pay for their medical, healthcare, welfare, and educational costs. 100%, that's a trust expense, pre-tax. Now for you as the trustee, The trust can't pay for your food, fun, and fashion. Okay, so it can't pay for your clothes and stuff like that, like it can for the kids. But the trust can pay for your medical and healthcare expenses if you're a trustee. So your health insurance, your copays, deductibles. Even if let's say you work a W-2 job and you have insurance, but you have copays and other things that your insurance doesn't cover, guess what? You can have the insurance pay for that. Okay. I'm sorry, you can have the trust pay for that. So insurance, trust and life insurance. I talked to a lot of people that love the concept of life insurance, infinite banking, bank on yourself, be your own bank, whatever. They understand the benefit of life insurance, but the mistake is they're doing it on a after-tax basis. So they're taking all their money, they're working, they're earning, they're paying money in taxes, and they're buying the life insurance policy. Or they're taking money out of their retirement accounts or 401ks or IRAs, they're paying the tax, which is the worst way to do it. If you're considering taking money out of retirement accounts to buy life insurance, it's a good strategy, but you're just doing it wrong. So we have other strategies that can help you. I'll send you my email. We can talk about that another time. But they're doing all these things, and the basic point is they're purchasing life insurance in an inefficient way. Use the trust to do it, because as long as the trust is the owner and the beneficiary of the policy, you can be the insured. You can do all your infinite banking. So it doesn't matter if it's whole life, IUL, term life, you can do that. The other thing is, even if you have insurance, and this happens all the time, life insurance claims. Has anyone ever filed a claim on a life insurance policy? Unmute yourself. Has anyone ever paid a claim? No? Well, it's a pain in the butt because of the death certificate. You need to get the death certificate, and that death certificate can take 4 to 6 weeks to get, sometimes even longer. And so there's some delays. And I've had a lot of times people, okay, yeah, dad left, a $4 million, life insurance policy. We're going to get some money, and whether they have a trust or they don't, but we're waiting on the death certificate. In the meantime, there's all these, the family's dealing with a lot of emotional things and family issues, and they got to deal with the money part, especially the immediate expenses, funeral, burial costs. They don't have any access to money. Well, we can set up provisions to give your beneficiaries liquidity within 48 hours of your death to cover all those expenses, funeral, burial, celebration of life expenses, without needing a death certificate. But again, that's coming from understanding how to set up a proper estate plan. So it's all about access, benefits, and control. And again, proper trust structure is key. You have to make sure it's set up the right way. There's very wrong ways to do this. You can just Google. People have gone to jail. There's an IRS memorandum that came out last year from people that are not setting up and managing these trust structures the right way. So it's just like anything else. It's like a gun, right? A gun is legal. It's fine. But if I go take a gun and I go air out a Walmart, that's illegal. That's not good. So you can do things the right way. You just have to be following the right instructions and that sort of thing. And this is an example right here. This is a client of mine that this is their income in 2020. Now they have a home health company, and out of where do they live in? One of those Massachusetts. And you can see right here their taxable income this year was about $500,000, $498 to be precise. And their total tax bill, my office manager highlighted the wrong thing. If you look right here on the left on line 24, you'll see it was $174.82. So that was their total tax. So they made $500,000. As you can see, they paid themselves a whole bunch of money in W-2, and W-2 is not good. If you're a business owner, you should not be paying yourself a W-2. If you have an S Corp, LLC, sorry. And I'll explain to you in detail in a little bit once we go in the drawings. But W-2 is the worst way to pay yourself. Yes, it's better than paying self-employment tax, but there's a lot more efficient ways to do things. So they're paying themselves a whole bunch of money in W-2, and then they took distributions or dividends from their S Corp. So you can see right there, they're paying, they're giving a good chunk of money to Uncle Sam, right? And so once they had a trust, we figured out how they needed to structure their income, their expenses, all that stuff. Now they only pay themselves, and they insisted on doing it. It's fine. Paying themselves $74,000 a year, and you can see their total income, 56, no change in their lifestyle. Everything stayed the same. They just used the trust and started benefiting from the trust. So you went from a tax bill of about $174,000 to about $5,500. It's a big, big difference. But this comes from learning and understanding how to operate and use the trust the right way.
Hey,
So,
Seth, real quick,
yeah,
Philip has to jump off for a appointment, but he had a question he wanted to ask
yes,
before
yes.
jumping on.
Go ahead. Go ahead.
Can you hear me? Can you hear me?
Yes.
Yeah, I can hear you.
Okay. Okay. I was told once that a trust can be penetrated unless it's a copyrighted trust. Are you familiar with that?
Yeah, yeah. So all these types of trusts, these dynasty trusts are copyrighted, but I think what they
Okay.
meant is it's a non-statutory. So going back to those provisions, it's different because again, statutory versus a non-statutory trust. But yeah, these trusts, attorneys put these together, CPAs, all that stuff. These are all copyrighted. They're specific, and you can go to
got it. Okay.
firms and pay a lot of money. But yeah,
Got it. Okay. Yeah, because there was a case where some doctor had a son. He had all his stuff in a trust. The son had an accident because of reckless driving. The insurance paid, I think, up to 80,000, and then they asked for punitive damages for 250,
Mhm.
and they actually were able to penetrate the trust because it was not copyrighted. Does
yeah,
that
it
make
wasn't.
sense?
I think the terminology is off. It wasn't because it was copyright. It wasn't copyrighted. Didn't have the right provisions. So
Got
it
it.
didn't have
Okay.
the Spendthrift provision, or it wasn't statutory. Like there's all these different things that you have to have. It's a trust document. So the copyright, just like a book copyright or movie right, is everything that's in that particular thing, right? It's in that movie, in that
Right.
book. So they probably did have some copyright or some trust, but it didn't have those provisions, and that's how they were able to penetrate that.
Got it.
And
Okay. Thanks for clarifying that.
yeah,
That makes
yeah,
sense.
yeah.
Thank you. Thank you very
Yeah,
much.
no problem. No problem. So now the main thing to kind of understand with the timeline, especially now we're in July, we're almost halfway through the year. These are proactive strategies. This is not something you can do December 31st and expect to have good results. You need to have these things set up beforehand because all the income and everything has to go to your trust first. Has to go to your trust. It can't hit your personal bank account and then go to your trust. It has to be redirected to the trust. Capital gains. Hey, I sold a property. Well, when did you sell it? I sold it last week. Okay, this is not going to work. Oh, I'm about to close in a month. Okay, let's get your trust set up now so we can transfer the property into the trust and then sell it from within the trust. So there's a process of, we have to get the EIN created, get things notarized, the bank account, you have meetings with the CPA. So there's all these different things that have to happen, and it does take time. And I usually tell people it takes about a good part of a month to get everything set up. So if you know you're about to have a huge capital event, you're about to sell something, a business, real estate, a property or whatever, or if you have a business, an actual active business, and maybe quarter one and quarter two weren't that good for you, but quarter three, you're going to make, $250,000. We need to get your trust set up now so that that income can get diverted into the trust and not into your personal estate. So preparation is key. So that's pretty much it. We're at an hour and 23 minutes. So thanks for joining, and we'll start doing the whiteboard and Q&A. So you guys can unmute yourself and fire away.
Well, I'll just ask real quick, while everybody gets up the courage to unmute themselves for their own questions. Jason, who had to jump off earlier, I made sure to tell him I'll ask this question. He was asking what I asked you before we started the meeting is, what's an income level where this actually starts making financial sense to do this? Yeah.
And I tell everybody right up front, it obviously has to make sense. So the number for me is about 200,000 net. So after expenses, after all your deductions, whether it's a capital gain or it's income from a business or it's rental income, 200,000 is where it's like a no-brainer. It's like the cost for me to set up the trust. And by the way, when you set up a trust, it's really just the trust setup cost. After that, you're just going to have to do the tax return, the bookkeeping, just the maintenance. That's pretty much it. But it's going to be a no-brainer at around $200,000 of net income. Under that, could it make sense? Would you save some money in taxes? Yeah, but the cost of setting it up is probably going to be somewhere around the tax bill, if not more. Now, I have a lot of people. I was at a real estate investment meeting last night. Guy is selling a chicken farm, his gain is about maybe $100,000 or $75,000 from selling. So the capital gain is going to be less than the tax liability, but he's going to have a quarter, $750,000 that he wants that asset protection for. So for him, the asset protection and being able to say, hey, I can sell this. I have my money. I can wait, because he doesn't want to buy anything right now. He doesn't want to 1031 anything. Market's crappy. So he's keeping that money in his trust, and it made sense for him. So everybody's in a different position, but I would say around 200,000 net, again, after expenses, after you've written everything off. If you're still at $200,000 net, then that's when it's a no-brainer.
So that actually, we had a question in the chat, and that I actually kind of had a similar, correct me if I'm wrong here. So when you say it's a no-brainer, we're talking like a no-brainer for this year, but if we have plans to have real estate in the future and bigger incomes in the future, it might make sense to do it here. It's just that return on the investment might take a little bit longer.
Exactly. 100%.
Yeah. So Jared asked that in the chat. He said, if I'm in a position where it doesn't make sense yet financially to set up a trust, but I want to work towards that with my business and plans to acquire properties, is there anything I can do or things I should consider or avoid that would prevent me from setting up a successful trust with my personal assets in the future? So kind of same question, I guess.
Yeah, well, I would say number one, don't do an S corp, because, and I'll get into that with the whiteboard drawing. I'm just, matter of fact, I'll throw up the whiteboard right now. And again, I want to thank you guys for staying on, because I know it went over a little over an hour, but hopefully you got a lot of good stuff out of this.
Incredible.
And if you need to, again, the recording, you can go over some stuff. And matter of fact, why don't I right now, I'm going to put my email in the chat. So if anyone has any questions, after I'm going to be heading, I'm actually going to a real estate investor meeting in the DC area. I'll be up there for the next few days and going to Baltimore. So if you have any questions, just shoot me an email. I'll try my best to get to you this week, if not next week. But let me do that.
And this is being recorded also. We had some people that had to jump off, so we'll send out the recording to everyone that was on here. And so you can watch it back. There was tons of information here. But, this is just the tip of the iceberg, I think. Maybe Stefan can confirm that. It's just the tip of the iceberg. So there is a lot to go into. So if you do have questions, he's got his email there. You can reach out, set up an appointment to see if this sort of stuff makes sense for you. Or your clients. We had a lot of real estate people on here. Guys, you have people that are looking to sell their house. They're on a listing appointment. We talked about that. He mentioned the 200,000. That's going to be a big thing for people that are selling their house. If they've bought it anywhere before 2017, 2018, they may have those big capital gains tax that they're going to pay. And so this might make sense to get something set up before we go through with the sale of their home.
1,000%.
Melissa says she has a client that would like the information. I'll write that email down and get the recording out as well to that person. What's the client's name, Melissa, if you don't mind? Or you can do like a private message if you want.
Yeah. And you can just send me an email too. But I'm going to switch over to my iPad because can everyone see me, hear me? Okay.
I can see you, yes.
All right, perfect. I'm gonna bring up my whiteboard because I want to answer this guy's question about the what he needs to do or what not to do. So the biggest thing I would say is don't if you're setting up your business, you don't want to set up an S corp. And let me pre-qualify this by saying that S corps are better than nothing, and it's better from a tax standpoint than being a single member LLC, right? Because you're not getting killed with that self-employment tax. So can everyone see my screen?
Yes.
See my screen? Okay. So the S corp, right? You have your S corp. You make, let's say, 100K from the S corp. 100K from the S corp. You are required to pay yourself a W-2 salary, right? And then you can take the rest in K-1 distribution.
Okay. This one, you're not paying that. This one avoids that self-employment tax. So no self-employment tax, no 15.3% tax, which is ridiculous, right? But this one, you're going to pay half of that. You're going to pay half of that, 7.5 through yourself, and then the corporation gets to write off the other. Either way you slice it, you're going to pay tax on this whole amount. So all of this is going to be subject to federal and state tax. So you have federal and state tax. And from a trust standpoint, W-2 income, remember we were talking about active and passive income. That W-2 income cannot go in the trust, only passive income. So I mean, a lot of times, like I showed you that case study, they're paying them. These are two people that are in, the healthcare field industry. They're paying themselves, close to $250,000 in W-2 salary because their CPA said they need to pay themselves that much, and they didn't need to do that at all. So they're paying a lot in taxes, and you can't put that into the trust. So I would avoid doing an S corp. If anything, set up an LLC, keep it as a single member disregarded. And then you can always elect to change it to a partnership later. And that's one of the strategies that we use for people that have active income. So if someone has an active business, they're, real estate, for their like commissions I'm talking about, not from like rental properties, but they're a real estate agent, or they're in sales, or they have a business, retail store, they have an LLC. You can keep the LLC, but the S corp election is not very helpful. So that's one bit of advice that I would give. Anyone else? I want to kind of draw some things out so people can really understand how the trust works. Anyone else? Unmute yourself. I'm here, as long as you need me to be.
So I guess, can you explain, a lot of the people on here, Melissa's in real estate, Chris, who just jumped off, a couple of the Chris's that were on are loan officers, Sherry's in real estate, a lot of people, I guess I'm getting at, a lot of people on here are 1099 or maybe even W-2. Can you explain how someone who is a 1099 or a W-2 could use this to avoid because you said W-2 can't go in, but is there ways to shift things around to where the income can go into the trust instead of to a person?
Yes, 100%. So let me kind of draw that out. So when we're talking about active income from a business.
We lost your screen if you're doing the whiteboard still.
Oh, hold on. Wait, hold on. I think I know what happened. All right. See my screen now?
Yes.
All right. So with anyone that has active income, so W-2, 1099, if we just draw this is your trust, right? That income cannot go into the trust directly. You have to make it passive. So one of the ways that we do that is for the 1099. Now, W-2, if you're getting paid W-2 from an employer, we can't do anything about it because you don't have any control of that, right? Like, it's all about control. If you're a business owner, you have your own business, LLC, S corp, whatever, you can control that. So one of the easiest way that we can do that is through an LLC. And so what we'll do is you can keep your LLC, but instead of it being an S corp, you can have it be taxed as a partnership. Okay. And what that allows you to do is that allows you to amend your operating agreement or structure your operating agreement to where you, as the general partner, okay, and there's different ways to set up partnerships, but one of the ways would be you set it up as a general partner, so that's you, okay, and then you have your trust as a limited partner, okay, and so what we would do over here is a limited partner. Remember, limited partners are really, they don't have any ownership shares or anything. They're just like really investors. So the trust would just invest some money. It doesn't have to be anything huge. It could be $500, $1,000, whatever. But we can structure that trust to be a limited partner and take about up to 90% of that net income into the trust. And so that was the case that you saw with those people in Massachusetts, the home health care agency. making, $500,000, we can say, hey, we can take, $300,000-$400,000, set up the partnership and have all that money go into the trust, right? Still keep our business operating it the way that it wants to, but we can do that. And this is an up to number. Some people may not want to do 90% because they have other expenses or they need more money in their personal estate, right? Because you're always going to need money to buy groceries, go on vacation, things that aren't necessarily trust expenses, what we call food, fun, and fashion, right? Those aren't typically trust expenses. So everybody's going to have a different situation of how they want to structure it. But that's where you as the general partner would take the rest of the money and you pay tax on that, but you're not paying tax on 100% of that income. Okay. So that's how it would work for people that are self-employed. They have an active business, 1099, self-employed, independent contractor. That's kind of the way they would do it. Another way is they could actually set up another trust. And this is what we call a dual trust structure. And not everybody can do this because there's different, depending on what kind of industry you're in, there's different rules and regulations of how your licenses need to be set up. But for a lot of people, put it this way, if you can set up a DBA, if your regulations, whether you're in healthcare or real estate or whatever, depending on your state, if you can operate through a DBA, which most places you can't, then you are able to set up what's called a business trust. And you can run all of your business activities, pay your vendors, expenses, all that stuff, just like you do now, but you're going to operate it through a trust, just like Standard Oil Trust or Hershey Company Trust, right? And you can do all of that and have all that income come in. And then whatever is left net over, the net income, and this is where we're talking about the simple and complex provision. This business trust would use a simple provision. So this simple trust would distribute at the end of the year, okay? It would distribute, let's say it's $100,000, right? That's the net income after all expenses. You made $1 million, but you netted 100. Okay, well now that net income, that 100K net income, it's taxable because it's using the simple tax code, but then you would make an executive decision as the trustee to declare this as extraordinary dividend, okay? And 100% of that, basically this trust right here at the bottom, your personal trust, or what I'll call family trust, would be the beneficiary of your business trust. So no assets would stay in here, only income. So this is income only. All your assets, your house, your cash, all that stuff would stay in here. And so at the end of the year, all that income, that 100K, would go into this trust and not be taxed at all. Okay. So there's different nuances, but that's typically how it would be for people to have active income.
Gotcha. So the concept when you said 90% into the trust with the partnership, it's like I'm going to try to put as many of my allowed expenses, like your mortgage payment, your car payment, into the trust as possible. And then that 90% is kind of dictated by like how much my expenses are. And then we can kind of basically make the trust pay for all those expenses pre-tax, which is huge, guys. Like if you don't get that, if you get a $10,000 check and you have to pay taxes first, you only got $7,000 to live off of.
Yep.
But and then you're paying out of that. But if you have that full 10,000, you pay the money, and then after your expenses, that's what your tax is on.
Yep.
It's a way better situation to be in.
It puts it in it's a much different way of doing things. And again, I tell people from experience, it took me a while to learn how to do this stuff myself. Even though I've been in the tax business for a long time, I've only known about this stuff for the past 7-8 years. Yeah. So, and when I really understood it, I started implementing it immediately because it made so much more sense. And it's a lot more, it actually simplifies your life. You don't need, hiring your kids, doing the 14-day self-rental, trying to write off everything that you can, write off your car, all these, the subway, whatever, I wrote that off. You don't have to do that when you're using these strategies. It's just a simple tax structure.
Cool. So Jared, if you can, maybe put it in the chat. Did that answer your question? And then while you're doing that, Rosario, I saw you came on video for a second. Did you have a question as well?
Yes. Sorry.
You're good.
Yes, I did. Because he had asked earlier, like if we had done claims for life insurance, and it was a huge headache. I had to do that a couple years ago, and it was a huge headache. There's a lot of this stuff that we didn't have in place. So my question was, how can I get into this space myself? I do own a home, and I do want to eventually potentially see if I can rent it, and kind of create that income. Right now I do have a business. It's a startup business, so I'm working on that. And so I wanted to know, like, how can we incorporate this? Because I know it takes preparation. So while I get there, have it in place, and that way I don't have to, because now it's only me. So I want to be able to have my children set up where they don't have to deal with what I dealt with.
Yeah.
So
yeah. And I tell people, everyone's at a different stage and all that stuff. So as much as I said, yes, living trusts don't get any living benefits, it's better than nothing. And if you don't want to go through the headache of probate, get it set up. And we have, and I do that all the time for people. Get a starter trust set up, and then guess what? When you have the money, when your business is doing well, when you have investments, okay, then you can migrate, you can graduate to a bigger, like a Dynasty Trust, and have the probate plus the asset protection of the tax benefits. But something is better than nothing. And I've even talked to, about 3 or 4 months ago, I had a conversation with a woman who her boyfriend was an estate planning attorney. So you're talking to an attorney that passed away, young guy, runs marathon, healthy as a horse, passed away, and didn't have anything set up. And she went through hell. So it affects different people at different levels, but you want to get something set up versus nothing. And so I always say, have something set up, get a living trust set up, because we don't, knock on wood, know when that's going to happen. When it does, we don't want our family, again, you love your family more than you love the government. Most people, they don't say it outright, but their actions are that they love the government more than they love their family, because they didn't take any time to set anything up. I mean, that's the long and short of it. But yeah, no, definitely. So yeah, send me an email. We'll have those conversations, and I'll walk you through what that looks like and how to get that set up. And it's a lot less expensive, obviously, because you're just covering all the bases. You're going to set up the POAs, the advanced directives, pour over wills, which is not the regular, same as a regular will. And then obviously you're living revocable trust to avoid probate. So we'll talk about all those things for sure.
Yes, thank you so much for clearing that. And I do have POAs, medical power of attorney, and I do have financial one, and the living trust that you talked about with the will. So I have all those set up. But I do want you to see, like, how I can migrate the way you just said it.
Yeah.
To have this in place.
Yes. Let's definitely have a one-on-one conversation and talk about that in detail for sure. 100%. Yeah.
And just to reiterate, we will be sending out a follow-up email after this gets uploaded. It'll have the replay link, and then we'll have all Stephan, my contact info, and a calendar link for him too, if you wanted to do that too. So we'll send that out to the email that everybody signed up for the event through.
Anyone else? Any other questions? I'm free until about 1:55, so then I got to start heading out, make my way out of town. But anyone else?
Any other questions? See, Melissa looks like maybe she's typing something. Sherry, you have a question?
You can unmute yourself.
I do have a question. Thank you so much for your time today. This is fantastic information. I am a real estate agent that still has a W-2 job, but I've also just bought a house to flip with a business partner.
Okay.
We bought it in an LLC, and I'm wondering, should we put this house in a trust? But it's the two of us. So how? Yes.
So and that can be, yeah, no, that and trust me, that this happens all the time. So let me draw this out, kind of how that works, because there's ways to make it work. Obviously, when you have a partner, and it's not a family member, things can be a little bit more complex. So one of the ways that I tell people is, when it comes to real estate specifically, just erase. Clear everything. All right, cool. All right, now I'm back in. Now we're cooking with gas. All right, so you can keep. So let me ask you this. So right now, what state are you in? If you don't mind me asking.
North Carolina. It's in
Cool. All right. So you're an NC, and what's your percentage of ownership in the partnership?
We're 50-50.
You're 50-50. All right. Now, have you filed a 1065 yet, or is this going to be the first year you do one?
Yeah, we've owned it maybe 6 weeks now. This is brand
6
new.
weeks. Oh, okay. And it's a rental property, right?
No, we're going to flip it.
Oh, you're flipping it. Okay, you're flipping. Okay, so this is a flip. Okay. Oh, this is easy. All right. So cool. So here's the thing. What you can do, because you've done a 50-50 partnership, right? And these are is it a managing partnership or a limited partnership? Do you know?
It's a LLC.
Yeah, but yeah. So all right. So it's probably set up that way. All right. What you can do is, you can take what would have to happen is you would need to amend your operating agreement, and this would not affect your partnership. Okay, so you would amend the operating agreement the way, and basically just say if you get a trust, and you could use a single trust structure. You wouldn't have to use a dual trust structure, and you could say, hey, I want to transfer my ownership of this LLC into the trust. So it would just be a transfer of ownership to the trust within your operating agreement. So you can keep the LLC operating the same way. If he says I hate trust, you can hate trust, and you can just have your stuff go over here. And probably I'd have to talk to the attorneys, but I mean we could probably do 100% of that tax free, up to 100%. So you flip it, that gain from that, because you're gonna file a 1065 at the end of the year when you flip it, or next year whenever you ultimately flip it. But whatever your income, your portion of that, your K1 distribution, because that's what you would get, your K1 would come in as a passive K1 into the trust. Okay. And again, that's one of the 6-way passive income. So yeah, we can do that totally and not affect anything with your partnership.
Okay, interesting. Thank you.
Yep.
So just a quick kind of add-on question to that. Let's say he did want to do a trust. Would you do it under one trust, or would each partner, because they're not related, keep things separate?
Yeah, they would do different trusts. Another strategy would be, hey, and again, this is a situation where people, once they understand how this stuff works, why don't you just run your business operations through the trust entirely? So you have a business trust, and the benefit of having the business trust really is the privacy level, because if someone tries to sue you or whatever, because that business trust uses the simple tax code, they can see all that stuff. But your beneficial trust would be completely private. They don't need to know who's the beneficiaries of that trust. So it just adds another layer of privacy for people that have that active income. But yeah, I mean, there's all sorts of different scenarios we can make it work. But I tell people all the time, as much as you like your partner, you got to do what works best for you. So, I don't like to have pissing matches with people with, you don't have to do the trust. Just this one partner wants to do the trust. We're working with people right now that have a real estate investment. They bought a big property out here in Pinehurst. There's like 21 investors, but we know 2 of them, and they're getting trusts. But the rest of the other investors, they don't need to be privy of anything.
Cool. Does anybody else have any questions before we log off? Going once, going twice. Done. Well, Stefan, this is incredible. I appreciate you spending the time with us. We went over a lot of information. So like I said, guys, this will go out to everybody. Do you have anything else you want to say before we shut it down for the day?
No, I just thank you guys. Hopefully you learned something. Hopefully you open your mind. Like I said, do your research. Go on Google. Don't take my word for it. Go on Google, ChatGPT. You took notes, you researched the terms, and see for yourself that what I'm saying actually exists. But then the next step is, okay, am I gonna execute this? And like I said, for some people, maybe you want to start off with a living trust. Okay. When at the end of the day, you have to make your decision of, do you love your family? Again, everyone's family is different. Do you love your family more than you love the government? So for most people, even the ones that aren't too happy with their family, they'd rather do that than give it to Uncle Sam, because they're just going to burn it, So start off with a living trust. Get something versus nothing, because you don't want your family. I mean, imagine working for all these years. You put all this effort, blood, sweat, and tears into your money, put everything together, and then when you pass away, and people don't understand how many people I talk to. A lot of people assume that, oh, this is only wealthy people, they have it all figured out. Most of the time, I'm talking to people that have 7-8 figure, wealth that they've amassed and didn't do any estate planning, and their families get killed. Yeah. So it's not just for the wealthy. Anybody can take advantage of this stuff. But start off with a living trust. If that's what you can do, you need to do something versus nothing. And then graduate. But just it's all about being informed. So hopefully this was informative, and you learned something, and you learned one thing that can kind of help you out. So
yeah, well, thank you so much. Really appreciate it. Thank you all for being here too. We appreciate you guys. This was great. We had a good attendance, so good interaction as well. So we appreciate you all, and this recording will go out in the next day or two. So you guys all have a great day.
All right. Great day. Bye.